And with that, we'll dive in. So the reason we put this presentation together was very simple. Avio works with startups, and I hear from many of you, including people on the call, that you get a lot of no's. And it's not always fun, it's not always easy. And we thought maybe there would be value in understanding better why investors so often say no. Of course, there are always exceptions, always caveats. And of course, some of this will seem obvious, some of it is obvious, but it's not obvious to everyone. And I've learned over the years that even if you've done something repeatedly and successfully, refreshing on the fundamentals can be valuable and help you avoid mistakes that maybe you long ago passed by. In this presentation, we're going to be going over information that we gathered from primary interviews. We went and talked to VCs, angels, and corporate investors, and we asked them, how do they make decisions? Why do they say yes? Why do they say no? We're not doing a deep dive. There's always layers and layers for each topic area. This is the surface level, the 101. But what I'd ask you to think about is areas where you might be the weakest and where you might be the strongest so that you can better address the challenges you have and hopefully increase the odds that you get to a yes from an investor. Just briefly, super briefly about Avio. We are a medtech consulting firm. We work with startups and small companies only because we get it. Your work is hard, prone to failure. It's high risk, high stress. It's hard on your mental health. Our team has been there. They've been entrepreneurs. They've bought and sold companies. They've had the highs and the lows. We are trying to live that with you and try to make it a little bit easier. We worked with 3 core groups: first-time founders, serial entrepreneurs, and established small companies. If we can ever be of any service to your work, please do reach out. Even if Avio can't help you, my commitment is I will help you track down the resources you need. All right, that's enough about Avio. Let's get into why you're here. These are the topic areas we're going to cover. And again, I'll remind you, some of these may seem obvious, but I will tell you, having seen hundreds and hundreds and hundreds of company pitches, many of these things come up over and over again, even from serial successful entrepreneurs. And so it isn't to say that if you're missing something, you can't be successful, but we think you could make your job easier and a little less stressful. Never easy, but easier. The first one, and surprisingly, I would think what should be the most obvious, but is lack of market potential. And this is particularly specific to venture capital. So venture capital being an asset class that needs certain levels of return and needs to deploy certain amounts of capital, they often require that a company they're investing in meet some sort of market size and market growth hurdle. If you have a startup that is going to make big clinical improvement, is a novel innovation, but is in a relatively small market, you might have a challenge. I saw one recently that was clinically novel, would improve patient care, but there were a grand total of about 7,000 procedures a year, and the device was about $50. That's just not a big enough market to get a venture capital investor excited about it because they can't generate the returns that they need for their own investors. The second one that we see quite often is a poorly defined customer. I talked to a lot of companies who they say they're solving a problem and that it's going to be used by primary care and by surgeons and by hospital administrators. You would be surprised how many times companies cannot clearly articulate who is going to use it, why are they going to use it, but then also who's going to buy it, how does it get bought, what do they value? What do they need in order to make a purchasing decision? Increasingly, especially for medical devices, it is no longer just the doctor making the decision to use a product. There might be a value analysis committee. You might need to get the payers on board to pay for it. You might need to get the operating nurses engaged in it. There are multiple stakeholders, and if you can't articulate who they are and why they care about your innovation, you're going to have a much harder time advancing your program. The third one, and this is the one that I probably see the most often as a potential deal killer, is insufficient team experience. And by this, I don't mean that you don't have the technical expertise or you've not worked on similar programs. Really, this is about belief. So when an investor is making a decision to put money into a company, they are saying, we believe this team, this technology, this market can deliver superior returns. If they knew the truth of that, well, they'd make very easy decisions then and they'd have infinite returns. They can't know the end result until it's actually happened. So rather, it's they need to believe that your team is capable of executing, taking their money and generating a superior return. That often means more than the technical or domain expertise. They love to see if there's a track record, you've been there, done it before, which I get is a really challenging thing because how do you ever get first time entrepreneurs if they always want to see someone who's been there, done it before? But what you can do is you can surround yourself with resources and people that elevate your credibility. So again, this is about belief. Do I believe you're capable? One of the ways my belief can be influenced is by seeing your board of directors, your board of advisors, the suppliers you work with, the story you tell, how the information is presented. There are techniques you can engage in that lift the credibility of your team and of your company that will then increase your odds of being successful in raising that money. The next one is having a weak or unclear business model. And I want to use an example that's a little bit from the digital health world as a way to articulate this. So in digital health, remote patient monitoring is very popular, very prominent. You see a lot of companies developing RPM technologies, and they usually say, hey, there's these RPM codes that if the doctor does this monitoring, they'll get paid for it. Makes sense, except that there haven't been a lot of companies that have demonstrated that those RPM codes get billed and generate profitable revenue. So the idea makes sense, but the validation hasn't been there. The other one we see a lot is a company that's making an incremental innovation and they're trying to claim that they will get premium pricing, premium reimbursement, and they can't really articulate how their product is differentiated, right? It's different, but not in a way that is necessarily meaningful to the end users. And thus it becomes very difficult to say, hey, here's why we'll get purchased, why customers will use it. Here's how we can demonstrate that at the price we sell for, we can be profitable, we can be scalable, and here's how we can reach a sufficient size of business to generate the return our investors want. This is why upfront it is so important to validate your market and validate the business model, not just have assumptions of, well, if you make a better product, it will get purchased. Rarely does the better product actually sell. It's the team who executes and has a better strategy to go and address the market. And then, of course, I think we all know about the importance of intellectual property, the challenge of both over-indexing on it, spending so much on IP, but having no product to move forward, or underspending on it and not having appropriate IP or sufficient protection or the freedom to operate. The good news is IP lawyers are some of the best folks at working with early stage startups. They get that they're going to be in a long-term relationship and that at the earliest stages, IP is very important, but may have limited resources. And if you're not on mute, I'll just remind you to mute your mic so that if you cough or something, it doesn't come through. We get that you need strong IP, but how do you do that, especially at those earliest stages? Building a good relationship with a strong IP attorney early on pays huge dividends. They often can get creative in how they bill, in their recommendations, and helping you focus on the right things to protect early on and build a strategy for IP protection so that you don't overinvest too early nor underinvest as the company matures and don't have the protection that you need in order to defend yourself in the market. Next one we see quite often is high regulatory hurdles. And I want to be clear, this isn't to say PMAs are bad, 510Ks are better. Rather, we get, if we're doing device, regulation is there, and that the approval and clearance processes can be complex and costly. What they mean by high regulatory hurdles is that you haven't provided them information to say that the regulatory path you're pursuing is the one that will get you the best market adoption. And you haven't demonstrated that your team has sufficient understanding of what is required that you will be able to effectively manage that process, right? A 510K may be the right answer because it gets you on market and that's what the market needs. But if you're entering a space where the evidence requirements are higher or where there's a lot of competition, maybe there's value in a de novo or in a PMA where you'll have a more differentiated product. You can make more unique claims about what you're doing and you'll have the evidence to prove it. So when they say high regulatory hurdles, what they told us was they weren't afraid of complex regulations. They were afraid of teams not understanding what would be required to manage that process and not understanding what the appropriate process to pursue for their specific market. Really, they want you to focus on market adoption, not market authorization. The difference being what needs to be done such that your product will get bought, that's market adoption, versus what are you doing to ensure you can sell, that's market authorization. If you're authorized, you can sell, but will a customer buy? Then a very easy one, frankly, that you can work on is poor presentation. If you're meeting an investor for the first time, if they don't know you already, they're going to have a first impression. Do you make a positive first impression? Do you tell them a story that brings them along to where they would want to invest? And that usually means you're telling them a story about how your company will generate superior returns, not just improve care for patients, not just be a big business, but will generate an ROI for the investors. Where I often see companies mess up on presentation is two areas. One, they're not speaking to their audience. The company talks about what they care about versus what the listener cares about. And then two, they do little things that take away from the quality of their presentation. I see so many times where a deck hasn't been proofread. The graphics don't line up. Their presentation cadence is halting or not very well put together. If you can do some of the things that just improve the quality of your presentation, it levels you up. Even if everything else is great, giving a poor presentation can leave uncertainty and doubt in the mind of the investor. And recall, they need to believe in what you're doing. It's not just the truth of it, but their belief in that truth, which you can influence through your presentation. Excuse me. Ultimately, what most of that adds up to is, do they have confidence in you and your ability to execute on the project? Right? They're going to give you a pile of money, and then you're going to go do a whole bunch of work that's going to try to generate a return. There's a lot of risk in there. There's a lot of uncertainty, and they've signed up for that. They get it, right? If they wanted certain bets, they would go and buy treasury bonds. But you can do things that increase the confidence of the investors and differentiate yourself from the companies that they're also hearing from. That's where building a great team, both your direct team, your board, and your advisors, being clear on how you will create a return for the investors. Having a simple but attractive website, that's effectively the business card of today. Someone meets the company for the first time, usually the first thing they do is they go to the website. And then also, a really underappreciated one, know what your weaknesses are, know what the gaps are, and address them up front. Bring them up proactively. Don't let them bring them up. Why? If you bring them up, you're showing that you get where the holes are. And trust me, every startup has holes. Every startup has problems. It also shows that you recognize them and you're thinking about what can be done to address them. That demonstrates you're thoughtful, you're probably higher ability to execute, and you recognize the reality of a startup, which is things will go wrong. It's not a question of if, it's a question of how are you going to respond when they do. Then we get into some of the tactical things. So everyone does a pro forma, and we all get they're made up. They're going to be wrong. There's nothing about them that's true or real. What's important about them is the company, the investors want to see that you're thinking through how money will flow through the business, what you're going to have to spend money on to create value, and what sort of value will come out of it. It's more about the directionality and the analysis that's done than about the actual numbers. So I don't think companies need to spend a lot of time trying to get to, the fifth decimal place on this. But you do need to think through what are the costs that are going to come up. I see a lot of companies that they really understand what it might cost to develop the product, but they haven't thought through what it'll cost to commercialize the product. And when some of those costs start to hit even pre-market approval or even pre-market, where you're starting to prepare for commercial launch, it might be inventory, it might be medical society meetings, it might be branding work. Thinking through those things and showing how the money is going to flow in and flow out demonstrates competency and increases the credibility of your team. And then the next one that we see quite a bit is, I won't just say high valuation, but misplaced valuations. As I understand it, there's really no magic to coming up to valuations. A lot of companies use market comps. Oh, and if you're not on mute, I'll remind you to mute your microphones. Where companies will get messed up on valuations is they'll think they've got the greatest thing since sliced bread, and maybe you do, but they're not thinking through the consequences of investments at high valuations. If you followed any companies that raised money in the midst of the pandemic, you're seeing some of the consequences of this. A high valuation can be a challenge in the next round. You need to grow into that valuation, and the higher it is, the less room you have for things to go wrong. Now, the flip side is you don't want to give away the entire company on day one. And I will not pretend to be able to say, like, hey, here's the right number to land on and the right way to analyze it. But there certainly have been companies who do go far beyond the norm and end up either not being able to raise money at all because there's no value for the investor, right? There's nothing they can grow into. Or if they do raise the money at that level, any little mistake becomes magnified and could tank the entire company. Next one is competitive landscape. Even if your company truly does not have a competitor product on the market, something is being done today, and you need to understand what that is. What is standard of care? What is the competition? And how do you stand out? And I want to be clear here. It's not being different, it's differentiation, right? There's a million ways we could test for COVID during the pandemic. We did not need a million ways. We needed like two. So if you're making an innovation in an existing market, why is it that your innovation matters? How does it stand out from the competition? Why would your customers choose your product over another product? And how have you validated that? And that doesn't mean you've made initial sales, right? Have you done market research? Have you talked to the customers? Have you done third-party interviews, right? When you're talking to them, you're going to bias the questions a little bit. So maybe you get an unbiased source to ask the questions to do the interviews. But what have you done to understand the competitive landscape and understand where you fit in it and how you'll stand out? Final one, and I'm always surprised when this isn't more explicit in a company's presentation, but it happens a ton, is not really having an exit strategy. Companies will just say, well, we'll get bought. Okay, by who, why, when, at what milestones, what kind of valuations are happening in the market right now? I hear so many times companies say, well, Medtronic will acquire us. And it's a company in an area that Medtronic is not even in. They just pick them because it's the biggest one, or they'll say J&J or Boston Sci with no real analysis behind why. Even if that strategic is in the market you're operating in, maybe their product is good enough. Maybe they already did a recent acquisition. Maybe they're not investing in that space. It shouldn't just be, here are the companies that operate in this space, but you should have some understanding of why they would be interested in it. Maybe that's relationships you have, insights on the market, but give some analysis as to why those companies would be interested and have some understanding of what sort of exit you could get, right? The market's going to change every day. The ultimate price is going to change, but you should have some sense of what you could get at the end at different stages of development. Why? Because it goes back to ROI. If ultimately your company will take $100 million of capital to reach an exit and the terminal value of that company is $100 million, you have a problem, right? You should know for the investors you're talking to, what sort of return profile are they seeking? And can your company create value in a short enough time frame to generate that level of value? If it can't, that doesn't mean you don't have a good business or you don't have a good opportunity, but it does mean you need to talk to different investors. Don't waste your time or their time engaging in conversations that structurally are not fit for purpose. And with that, I'll stop talking at you, take any questions you might have. This presentation is being recorded. It'll get sent out afterwards. But if you have any questions, pop them into the Q&A. It'll be a little bit easier than with the number of people on trying to talk through it. And I'll be glad to answer any questions you have. Let me just hit the stop sharing and move this back over. So yeah, go ahead and type in any questions, or if you want to do a hand raising thing and you want to vocalize it, that is a-okay as well. And if you don't have questions, that's okay as well. I know it's early in the morning. You got to get your second cup of coffee yet. All right. Hearing no questions.
Wait, Frank?
Oh, yep, go ahead.
Frank, good morning. This is Gerald Brecker. I'm just wondering about, let's say you've got a company that has either multiple different products or a technology that's applicable in more than one market. In my experience, I've talked to potential investors, particularly among the VCs, some of whom will say, no, you have to focus, pick the right one. And then others say, well, it's good to have, sort of the safety net of having multiple shots on goal. And I'm wondering what your view is and what your experience is about that question.
Great question. And I'll preface it with always exceptions, always caveats. Your mileage may vary, but you're talking kind of about like the platform issue. So if you have a technology that could be applied in multiple venues, multiple markets, on the one hand, multiple shots on goal. On the other hand, risk of spreading yourself too thin and not advancing any one program forward enough to create value. So what I've usually heard from investors is they like platforms, but they want to see a company focus on a lead to get to market, create value, and then maybe have a story of what product 2, product 3, so on might be. The other strategy I've seen quite often is a company will have that core IP in a holding company, license it to their startup for a specific application or specific indication for use, develop that, and then when they go to do the next company, they'll license from the holdco a different indication. So I think there are different ways you could approach it, but usually what I've heard is they want to see you have a plan for getting something to market and creating value. And Jerry, if you wouldn't mind going back on mute when you're not talking, just so it doesn't feed back in.
Hey, Frank, this is Landon. I have a question.
Yeah.
So you may have covered this and I stepped away to get a cup of coffee, so I apologize if you did. But just thinking about, investors looking at the potential profitability of a company and a company talking about their cost of goods and expected ASP and, what kind of that margin should look like for the investors that you've been talking to.
Yeah. So I think by and large, investors want to know that the company can get to profitability, of course. Depending on the stage of investment they're in, that may be more or less salient, right? Like a growth equity investor, a private equity investor might care more about the ability to grow profits along with top line. An earlier stage investor might be more focused on, what sort of revenue can it get to, and profitability is going to be someone else's challenge. So I think it depends on the stage. Your comment about the ASP, though, I think a thing that is important to all investors is an understanding of, do the unit economics make sense? Like, can you get the product down to a cost can you manufacture the product at a good price? Are your SG&A going to be too high? Can you build a business that is sustainable and scalable? Trying to think of an extreme example, but if there was no realm in which you could get your product down to a low enough cost to ever match what the market price is, and thus the only way you can be profitable is if you can get reimbursement rates up, and that might be challenging. So again, I don't think it's that they need to know, down to the nth degree, but it's, do you have an understanding of it? Are you doing the work to set the company up for success?
Thank you. I have one other question, if you don't mind. On IP and talking about the early stage, intellectual property protection. What are you hearing from the investors that you've talked to with regard to global IP protection, or at least the major markets, right? So not just US, but the other leading markets in terms of protecting IP.
Right. I will have to say I've not had that come up very much, so I don't know that I can comment on that fairly. And I think I'm certain they care about it, but I couldn't give you unique insight there. Apologies.
Yeah, no worries.
Yeah. And then I see there's a couple in the chat, so let me grab those before we jump to some of the others. Claude is asking to talk a bit more about ROI. Short version, fundamentally, they have their own investors. If you talk about a VC, right? They need to generate a financial return for their LPs. Usually they have some levels they need to hit. They might have spelled out to their LPs that, hey, we anticipate that this fund will generate X, Y, and Z returns over this period of time. They want to know, if they make an investment in your company, can you contribute to that return profile? And that's usually a function of, do you have a big enough market? Can you get to that market without spending too much money? Is there a potential for IPO or exit at a high enough price? Cash in, cash out, that's what they're going to be looking at. You as the founder, as the startup leader, need to be able to tell a story about how you can create superior financial returns for that investor. For a corporate strategic, it might be slightly different, as they might have non-financial reasons. They probably won't do a deal that financially just is a bad idea to begin with, but they might have broader reasons to do a deal than a purely financial investor. And then angels are as unique as snowflakes, right? Some of them purely want financial return. Some of them want to do good in the world. And some of them, if they have enough money, it's something they want to talk about on the golf course or with their colleagues. And so they might have different motivations for getting involved, but everyone fundamentally wants some sort of return on their investment. You should take the time to understand what the investor you're talking with, what return they want.
Hey, Frank, really good so far. I think some of the biggest challenges that I've run into that you can speak to is about that return. Is if you're in a market where there haven't been a ton of acquisitions yet, how do you really justify what your potential exit price could be? And then if you could also speak to reimbursement, especially if reimbursement is nebulous, how do you, in an early stage, speak to that to give an investor confidence?
Yeah, right on. Boy, asking the hard ones this morning. Or
Well, it's
afternoon, I suppose, for
afternoon for
you.
me, so
Yeah,
I've had
yeah.
time to think about it.
Fair enough. So on the ROI part for when there haven't been, prior acquisitions, yeah, that can be a lot harder. I mean, to some degree, there's math around what kind of revenue might you build in the business at some point, and then what are general multiples in the market? Who cares about these things? Are there surrogates, right? Are there other technologies in adjacent markets that might be similar and you could tell a story about what it's related to? You know, there is a lot of complex mathematics that goes into valuation. And then at the end of the day, it's kind of like, what do I want to pay? Right? If the market's hot or the market's cold, that price could be a lot higher or a lot lower. So I think I would look for comparators, how big can the business get at what stage and what are general revenue multiples in, say, the med device space, and start from there. On the reimbursements, and I would say also, it's also a reason why being capital efficient up front is so important, right? An extra $1 million on the front end might be the difference of 5, 10, $15 million in valuation on the back end difference, or in return, not valuation. So that early dollars can be even more important. On the reimbursement side, I don't think this has surprised anyone on the call. Reimbursement matters. It always mattered. It's mattered more and more and more every year, especially in the US, where we spend so much money on healthcare. Here's the short version. We're running out of money to spend on healthcare. So increasingly, there's trade-offs. If we're going to do this, what aren't we doing? Or who else is getting punished for that? So I think I would advise that companies very early on understand what the reimbursement landscape is. If the reimbursement landscape for the product is not great, then what sort of evidence would need to be developed? What sort of work would need to be done in order to improve that? And I would figure that out real early in development. Why? Because what if the answer comes back that you're going to need, I'm making this up, a 5,000 patient trial with 10 years of follow-up? Well, that might be a hurdle too high to jump, and you might need to pivot or rethink the strategy. So having those inputs early allows you to make decisions and then talk about the value that can be created or pivot to a better path forward. I'm going to take a couple that are in the chat, and then I see a person with their hand raised, and I'll get to you. So on the chat, Posse was asking about company location, headquarters location, if that has influence. Yes and no. There are more U.S. investors today who are willing to cross borders than there were in years past, but it is still a challenge. In the U.S. market, the U.S. investors have a lot of options. There's a lot of deals that they get to look at, and investing overseas introduces additional risk around tax and legal and just the distance and being able to interact with the company. It's not necessarily a deal killer, but it can be a barrier, and it's something that you should be talking to the investors early on and understanding, are they on board with it or not? If they're not, that probably is not something you're going to change unless your deal is truly amazing, and then you may need to think about your operation strategies and how they impact investment. Gary's asking a question about finding and identifying good angels. Finding angels is hard, and I sympathize for every single person on this call who's raising money. VCs are a business. They have a website. You can look them up. You can track them down. Most angels, especially if they're very wealthy, they're private. They don't want you to know about them unless they want you to know about them. Thankfully, there are more and more angel groups and organizations that have been organizing the angels. That tends to be the best way to find them. Other than that, it is a lot of networking with folks who fit the profile, right? Who are people who have jobs that are likely to pay enough to make them accredited investors and might have an interest, right? Like people who work at the corporate strategics probably make enough. Lawyers probably make enough, but it is kind of hand-to-hand combat, unfortunately. Colin's asking a question about investor appetite for a solution that needs new reimbursement versus a Me Too. You know, I don't, a lot, it's a hard, investors are willing to back creating new reimbursement if the payoff on the other end is sufficient. Right? If there's a credible path to new reimbursement will generate superior returns, investors will do that. It can be a harder path, but it may be the most appropriate path for that product or technology. Where I have seen for 20 years companies mess that up, and I should say prior to doing this, in my prior work, I worked a lot with health insurers and with hospital systems. Medical device companies do not get an understanding of the challenges payers have early enough and do not treat them as a stakeholder in their products, right? There are pathways to get payers to pay for novel innovations, but you need to treat them as a stakeholder just like you would the doctors, the hospitals, and the investors, and understand their needs and how that might influence product development. It can't be a thing that you do later on and hope you figure out. It's got to be way at the beginning and part of that core strategy, or it's going to take a very long time. And then there's a person with their hand raised. It looks like Alyssa. If you wanted to ask your question now, thank you for waiting.
No problem. Thanks, Frank, for all the input. We're in the middle of due diligence with 2 VCs and have 2 other VCs that we're talking with. And we need to bring in some capital to close out our convertible note. And we have an investor for potentially 300,000. But again, we're between seed and about to start Series A. Or we're in convertible note and about to start a Series A. And the investor wants us to give him a firm understanding of how much of the company he would quote unquote own in exchange for his 300,000. And it makes me uncomfortable and to answer that, knowing that we're probably going with a VC. How would you answer that?
This might get beyond my capability, so I'll preface that. But if I'm hearing you right, you've got a convertible note. Are you raising 300,000 in that, or is that like a bridge between the convertible and the Series A?
It's a 300,000 note in the convertible note.
Got it. And that conceivably then the convertible note has some terms. It would convert at the Series A, probably.
Yes.
Yeah. So, depending, it probably depends on what terms are in the convertible note. Maybe you can't give a firm answer because it'd depend on, what terms you come to with the venture investor, but maybe you'd be able to give almost like a chart or a grant, like, in different scenarios with the Series A investor, here's what it looks like for the convertible investors. Like that might be the best you could do unless you already have agreed to terms from the venture investors, since that might, influence what happens when the note converts.
Yeah, we haven't even seen terms, so we're only in due diligence. So that's what makes me nervous to put any actual figures out there, is because that could drastically change on the terms, and the environment's not a great environment if you don't have the big funding, and we're getting our 510K soon. So
yeah,
would you?
I don't know that you could give a firm answer, period. Then, right? Like there's some things you can't do.
Would you just recommend passing?
I think you did. So if I put on my sales hat for a moment, customers sometimes, and I'll tell you, when you're pitching investors, you're in sales mode. Customers sometimes will make unreasonable demands to try to either extract things from you, or maybe they just don't know what they're talking about, or it could be a billion reasons. The advice we would give in sales is go right back to them with an honest answer, which in this case might be, hey, we can't give you a definitive answer. And if that's what you need, then, we can't, like sometimes people want to push the other side around. Don't be pushed around. Be respectful, of course. The other would be is you could offer to say, like, I mean, we could model out scenarios, but it's uncertain until we get this next investor, and that's the facts.
Okay. All right. That's kind of what we were thinking. Thank you so much,
Yeah.
Frank.
Yeah. Going back onto the chat for a moment, there's a question asking, considering investors, they're asking about, like, say, the Twin Cities versus Boston versus the Valley. Any differences that can be highlighted on appetite for early companies? Is there a Midwest effect? So I actually think there is not a difference in risk appetite among geographies. And I know I might be an exception to this, and that other people think that the Valley is more willing to take risk. I think that's a misunderstanding of what's happening. So there are more investors in the Valley and in Boston than anywhere else on earth. About 50% of global venture capital is in Silicon Valley. About 25% is in New York and Boston. And the next 25% is in the whole rest of Earth. So there is a larger market, A. B, we often, I always mix up numerator and denominator. This is why I'm in sales, not math. But the top of the fraction, the number of companies that are raising money and the number of companies that raise money, we always talked about that. No one ever talks about, well, how many companies tried to raise money? And in my entire career, no one has ever been able to give me an answer of, do a higher percentage of companies in Silicon Valley raise money than somewhere else? And I promise you, the evidence is not out there. The data does not exist. So it is an assumption we all make that other places are less risk adverse than some other place. I will tell you, I've talked to companies in Silicon Valley who have said, it's not as good as it used to be. The investors are so risk averse now. They only want to invest in the next AI thing. Everywhere you go, the grass is always greener somewhere else. Good deals tend to get funded, but it's still hard. I had a board member who was at a venture fund who said, on average, she wanted to see 300 to 500 deals for every one check she wrote. That meant it would be easier to get into 3 Ivy League universities at the same time than it would be to raise funds from an average venture fund. So I don't think there's a regional difference. I think rather there's a selectivity bias or a survivorship bias because there's a larger number in the Valley or in Boston than, say, in other areas. I'm going to jump over the Q&A because there was a question in there. Let's see, Midwest effect. Hang on. Courtney asked a question, how do you battle investor confidence in the current political landscape? This is a very salient and real thing, and I'm wondering this as well. So my observation has been, so far, investment, it hasn't slowed nor picked up. Like, I think a lot of us coming out of the JP Morgan event, there was a big high. People thought things were going well. It's tapered a bit. And there's a belief that given the economic challenges, the political challenges we're seeing in the US, that is going to weigh on investment. And I think that ultimately is true. I have not seen it truly play out yet, but that may just be, there is momentum from deals that were already in the works, and we won't see the impact of this until, say, the end of Q2. I don't know that there is a way we can battle other than one. If you're in medtech, you're talking about far longer than any government administration, right? These are projects that are 5, 6, 7, 8, 9, or 10 years at a time. If you're making decisions about 10 years from now based on the market today, that's going to be a very hard environment, period. So I think it's articulating that, hey, we're going to be operating sort of outside of that environment. 2, risk mitigation. What are you doing to be capital efficient, to not be dependent on, say, any one geography or any one set of risks, and to make sure that if something untoward does happen, that you have ways of managing it. But the good news is we're all in the same boat. We kind of all got to deal with it. Going through, what are the next questions? Oh, no, let's say, I see Alex and Alyssa having a nice discussion about the question they had. Any other questions from anyone? I'm not seeing any more in the chat. I'll check the Q&A. I am not seeing any others. One last call for questions.